All right, welcome to The Explainer. Today, we're going to get really practical and talk about one of the most fundamental skills in trading, actually placing your orders. Now, I know it sounds simple, but trust me, getting this right, this is what protects your money and lets you trade with some real confidence. So, why do so many beginners lose money? It's a huge question, right? And the answer, a lot of the time, isn't that they picked the wrong stock. Nope, it's that they used the wrong tool to trade it. So many people have the theory down, but they're missing that practical skill of execution. And, well, that's a very, very expensive gap in your knowledge. Yeah, this quote from our source material just hits the nail on the head. Placing an order. That's the moment. That's where all your research, all your analysis suddenly meets actual real-world money. It is the final critical link, and if you mess it up, it's going to cost you. Okay, so let's bridge that gap. Right now, we're going to move from just knowing what you should do to really understanding how to do it when the pressure's on and your money's on the line. You know, it really is this simple. You wouldn't use a hammer to drive in a screw, would you? Of course not. Using the wrong order type when you're trading is just as clumsy and honestly, just as ineffective. So our goal here is to give you a full toolkit and show you exactly when to use each one for surgical precision. So let's open up this toolkit. Let's break down the essential orders that are going to be the foundation of all of your disciplined trading from here on out. First up, the market order. Think of this as your get me in right now button. It guarantees that your trade will happen. It will get executed. But, and you have to hear this part, it does not guarantee the price. You get whatever the market is offering in that split second. And you know, our source material has a great little analogy for this. A market order is kind of like that frantic, last-minute shopping trip. You burst into a store and you're like, I need that shirt for an event tonight. I don't care. I'll pay whatever the tag says. The priority is getting the shirt right now. It's not about haggling over the price. Now, on the complete opposite end of the spectrum, we have the limit order. This is your price is everything tool. You are the one who sets the absolute maximum you're willing to pay or the minimum you're willing to accept. So this guarantees your price, but it offers absolutely zero guarantee that the trade will ever happen. If the market doesn't come to your price, your order just sits there unfilled. And to keep our shopping analogy going, this is like being a patient bargain hunter. You see something you love and you think to yourself, you know what? I'll only buy this dress if it drops to 2,000 rupees or less. You've set your price and you are more than willing to just walk away if you don't get the deal you want. So when you look at this table, it all boils down to one simple trade-off. Market orders, they're all about execution. Limit orders, all about price. Picking the right one just depends on what your goal is for that specific trade. And hey, notice that third one there, the stop loss? That's a purely defensive tool, and we're about to give it our full attention. Okay, I need you to lean in for this next part, because this is arguably the most important tool you have for managing risk. Seriously. If you only remember one thing from this whole explainer, make it this. The stop loss is your absolute ultimate financial shield. So what is a stop loss? Well, it's a purely defensive move. It lets you decide, ahead of time, the absolute maximum loss you're willing to take on a trade. If the stock price falls and hits your trigger price, the order automatically activates and sells your shares. It's like having insurance, right? You set it up and you hope you never, ever need it. But it's there to stop a small problem from turning into a total disaster. And this is where things get a little more nuanced. See, there are two flavors of stop loss. The stop-loss market order is your emergency eject button. It guarantees you will get out, but you might get a worse price if the market is moving really fast. Then there's the stop-loss limit order. This one guarantees your exit price, but in a real market crash, it might not get filled at all. So you have a choice to make: certainty of escape or control over the price you get. Let's make this real. Let's walk through an example so you can see exactly how this plays out. Let's say you buy 100 shares of a stock at 1,500 rupees a share. That's a total investment of 1.5 lakh rupees. The very first thing you need to do is figure out how to protect that capital. So you decide, okay, for this trade, my personal risk tolerance is 5%. The math here is simple. 5% of your entry price is 75 rupees. So you place your stop loss trigger at 1425.
That's your line in the sand. If the price drops to this level, your shield goes up. But here's where that trade-off we just talked about becomes very real. There's this hidden cost called slippage that can pop up with a stop-loss market order. Your trigger was at 1,425, right? But in a frantic market, the best available sell price might actually be 1,420. Now, that 5 rupee difference might not sound like a lot, but multiply that by your 100 shares, that's an extra 500 rupee loss that you didn't plan for. And that, my friends, is the real-world cost of guaranteed execution. All right, so now that you've got your personal shield set up, let's look at the market's own safety mechanisms and what their signals mean for your trades. These are called circuit breakers, and you can think of them like speed bumps for the whole market. When a stock's price moves way too far, way too fast, either up or down, trading just stops. It's an automatic halt. And this forces everyone to just take a pause, prevent a panic, and reassess the situation with a cooler head. So when a stock hits an upper circuit, it means there is just extreme, over-the-top positive feeling about it. Everybody wants to buy, and absolutely no one is willing to sell. And a lower circuit, you guessed it, it's the exact opposite. It's pure panic. Everyone is desperately trying to sell, and there are no buyers anywhere in sight. They're both really powerful signals about what the market is thinking. And another signal you gotta watch for are market gaps. This happens when a stock opens for the day at a price that's dramatically different from where it closed the day before. And it literally creates a gap on the price chart. This is the market's instant gut reaction to big news that happened overnight, like a surprise earnings report or a major global event. Okay, we've gone over the tools, we've looked at the market signals. Now let's pull it all together into a smart, actionable playbook for disciplined trading.
Think of these 5 rules as your personal trading constitution. 1. Always, always set a stop loss. Knowing your exit is just as important as knowing your entry. 2. Use the right order for the job. Don't just get lazy and hit market. 3. Avoid FOMO orders. That fear of missing out is the #1 enemy of profit. 4. Size your positions correctly. This protects you if any single trade goes south. And 5. Review and learn. Your trading journal, that's going to be your best teacher, period. So, from now on, before you even think about clicking that buy or sell button, I want you to run through this final checklist. Just ask yourself, have I actually analyzed this? Do I have a clear target and stop loss? Is this the right order type for what I'm trying to do? Is my position size responsible? And the biggest question of all, am I trading based on a plan or am I just reacting to emotion?
By mastering these orders, you've really conquered the how of trading, the actual mechanics of it. But the journey, it doesn't stop there. The real challenge, and frankly, the real opportunity, comes next. Mastering the what to buy and the when to buy it. And that is the world of analysis. And it's the next big step on your path to becoming a truly strategic investor.